Hi, and welcome to another episode of the Michael Yardney Podcast, where I love to delve into the world of property investment and give you some insights from Australia's leading experts in their field. And today I'm pleased to have independent financial advisor Stuart Weymss, founder of Pro Solution Private Clients, with me again, because he recently wrote a blog exploring what we can learn about an investment property from its yield, its returns. So in our conversation, we're going to explore some dynamics of rental yields, understand how they serve as an indicator for property's potential. And spoiler alert, it's not how most people think about investment properties and yields and returns. We're going to be discussing about the influence of location and other property attributes, how it all relates to yields. So Stuart's insights, of course, are backed by years of experience and a deep understanding of Australia's property market. So he's a great guide for us in this conversation. So let's dive into the world of rental yields with Stuart Weymss and see how that helps you think slightly differently about your property investment journey.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Stuart.
Hey, Michael. Great to be back with you again.
Fantastic. Now, Stuart, as long as I've been investing, there's always been a debate about what's important for property investment. Is it rental yields or is it capital growth? And obviously, different strategies suit different people. And depending upon where you are in your investment journey, your emphasis on yield versus capital growth is likely to change as well. However, you and I have been around the block a few times now, haven't we? And we've been involved in property for long enough to see the results of our clients and the various property investment strategies they use. Now, I enjoy receiving your blog every Wednesday. I love listening to your Investopoly podcast, and I recommend it to anybody who's listening to this. I'll give a link in the show notes, and please stop at some stage and just invest in your time in Stuart's Investopoly podcast. But anyway, I enjoyed an episode recently that discussed what yields tell about a particular property. So I'd like to delve into that a little bit more if we could, please.
Yeah, absolutely. And, I think it's a really good topic to talk about because obviously there's two elements to a property investment return. So you're going to get the income from the property, which is the rental yield, which we'll explain in a second, and then the capital growth element. And it's those two attributes that are going to make up your total return over the long run. And it's really good to think about these things in terms of what drives capital growth and what drives rental yield, because in the long run, we've got to assume, I think if we're reasonable investors, we've got to assume that we're going to earn a certain total return over the long run. I mean, it's nice to think you're going to invest in property and you're going to get 15% compounding returns and high rental yields, and that may occur for very short periods of time, but it's not going to occur long term, of course.
Well, I think that's one of the things. We've got to go back and see what historic yields have been. But sorry, I interrupted you. Please go ahead.
No, that's okay. To make sure we start off with realistic expectations, given that property is a long-term investment, and most people that go out and buy a property probably intend to hold it for 10, 20, 30 years, whatever it might be, whatever it is, it's the long term. And so sometimes we get distracted by shiny objects in terms of, this property that's yielding this, or this suburb has grown at this pace for the last 5 years. And that's all nice, but it's just noise. Because really what we've got to decide when we buy a property is what will its long-term average return be over the ownership period, which again might be many decades.
Well, that's interesting because the longer we've been in property and understand the fundamentals, we can also see patterns, and you and I have been in it for a long time. So we haven't liked some of the things that have happened to our markets and to interest rates over the last couple of years, but there's a pattern that's formed that you need a perspective of. So there's a lot of people at the moment who have never experienced rising interest rates before. There's lots of investors who've never experienced inflation before, and they're not sure what to do. They get concerned when all that happens. And unfortunately, there's a lot of advisors out there, a whole range of new advisors who are very data-driven, but I'm not sure they even understand how to interpret it properly. So I guess your and my job for our clients is to bring some simplicity to the complexity and the chaos by seeing the patterns and putting them together. So let's start with some basics. And I guess one of the patterns I was hinting at when I thought about what you were saying is that there's a combined return, capital growth and yield. And if you get more capital growth in general, you get less yield. And over the long term, they come to a particular figure. But they're not both the same either, because you don't get taxed on capital growth while you do get taxed on rental returns. But let's get back to what is it? So everyone's on the same page. Maybe you could define rental yield for us, Stuart.
Generally, the accepted definition is the gross amount of income that a property will generate as a result of having a permanent tenant divided by its current market value. And it's expressed as a percentage of that current market value. And so yields in Australia tend to range just broadly between 2 and 5%. And so you might get 5% for an apartment, for example, and a house in a blue chip location that's mostly land value, maybe you get something closer to 2%. But that's what we're talking about. And I totally agree with you, Michael, in terms of being too data-driven. And we're going to talk about data, obviously, today because we're talking about rental yields. And the reason that I like to talk about this topic is that I think it's good because it gives you a hint as to where to look a bit closer in respect to a particular asset. It's not definitive. You can't look at a rental yield and then draw definitive conclusions just solely based on that rental yield, but it's really about building, a pool of data. And when I say a pool of data, it can be objective things like rental yield, but then subjective things like understanding the location, understanding the type of asset, the tenant that might go into that property, all the sort of soft things that I guess, surround a property investment that are equally important.
Well, I remember when I first started investing, yields for residential property were much, much higher. So you're right. Today they're between 2 and 5% gross, and then you've got to take other things out of those. Investment grade properties usually have a yield closer to 3%. But I, from memory, were getting 7 and 8%, 9% on residential properties 40, 50 years ago. But at that time, my mortgage costs were around 7%. So I'm not talking about those terrible times when interest rates got very high. I remember when my home loan was less than 10%. I thought it was really, really good offering at the time. And the yields were a bit higher than the mortgage rates. And there was still, despite high interest rates, despite the high yields, there was still ability to get strong capital growth.
Yeah, so if you look at the long-term data, yields were much higher in the 80s, as you've alluded to, Michael. And when you look at long-term data, yields, this median house yields in capital cities have grown at the pace of about 3.5%. Which is more than inflation, because you look at over that period, inflation's about sort of 2.5%. So it's outgrowing inflation, but of course capital growth over that period of time has been sort of circa 7%. So it's natural then to expect a contraction of yield. So the thing I've been thinking about is that when you chart yields over a long period of time since the 1980s, you can see the yields sort of coming off on a curve. Except for the last sort of 1 to 2 decades, it's sort of stabilised. Yield hasn't really changed that much. And so the thing that I think about...
Can it fall any further?
Yeah, well, that's right. Yeah, that's the point.
We need to get some cash flow to support our mortgages.
Yeah, that's right. So the thing I've been thinking deeply about is, well, if capital growth continues, is it reasonable to expect that my yield will remain steady? So if I buy an investment grade house today for, say, $1.5 million in Melbourne, and I'm getting a 2% gross yield, will I get a 2% gross yield 20 years from now? And it's kind of an interesting thing for
the
investors
future
to think
value.
about. Of future value, yeah, correct, of the future market value. And it's kind of an interesting thing for people to think about, because when we chart a property's cash flow, that's a critical element. My loan's going to stay the same. Interest rates will change over time, but the average rate's probably going to be relatively similar to the average rate over the last 30 years, so that's fine. And so the only thing that's going to turn that property from negative cash flow into positive cash flow is the gradual increase in dollar value and rental income. And so if we assume the yield stays at 2%, that property will start to be positive cash flow in 10 to 12 years. But if it doesn't stay at 2%, if yield contracts further, it might take 15, 17, 18 years to turn positive cash flow, which is kind of an interesting exercise. And what I've arrived at is I think yields will compress further, but to a lesser extent than what they have over the past period of time. Because as you said, Michael, investors need some income to defray some of the holding costs of that property, and they can only go so low. Yeah.
Well, what drives property yields then? Let's go back to some more basics. Why do some properties have more yield, higher yield than others?
Yeah, I've said over the years that investors should pay for land because renters will pay for accommodation. So that is, as a renter, I'm more interested in the amount and quality of the accommodation. I don't really care about the land value. In fact, for most renters, they don't want to look after a garden. A big backyard doesn't really add that much value for most renters. And so what they're really interested in is living space, number of bedrooms, whether it's got a study, the quality of the finishes, all those sorts of things. So renters will pay more for more accommodation, but investors should pay more for more land value. So therefore, the properties that have predominantly more accommodation in terms of value than land value tend to generate a higher rental income. And so if you look at, say, new build properties, so if you go and buy something off the house and land package or something like that, it's a house, but you're probably going to get 4 or 5% in terms of gross rental because most of the value is in the actual new building. Whereas if you go and buy a single-fronted Victorian property, a 2-bedroom Victorian property that was built more than 100 years ago, you're probably going to get something closer to 2% because most of that, the value of that property is in the underlying land rather than the improvements that sit on that land. So the building and land component is really the biggest determinant of yield.
Mm-hmm. I guess there's a couple of other things as well, really, isn't there? Because if you're expecting more capital growth, you're in general prepared to accept a lower yield. And in reverse, so may I say with commercial property, which is different, we're talking residential, but commercial property where the yields work on totally different criteria, and in general leases linked to rent increases linked to the CPI, people expect a higher yield but lower capital growth because rents in some ways are pegged to the CPI.
Yeah, that's right. And it's really about supply and demand. So if I'm going to go and invest in a regional area where there's not a lot of supply of rental properties, I'm probably going to be compensated by having a higher rental yield. But because I'm investing in an area
and you're probably also wanting to cover your risk by having better returns too.
Yeah, that's right. But also because I'm investing in an area where there's an abundant supply of land, it's likely my capital growth is going to be lower. So this is one of the cautions to investors that are dazzled by a high rental yield. There's no such thing as a free lunch. If you believe that rental yield will persist for the term of the ownership, so I'm getting 5% and I'll always get 5%, then you're not going to get as much capital growth as you might expect from a lower rental yield property. So that's the key thing here, and the fundamentals behind that is really about what is driving that rental yield. Is it artificially high? And that's fine. Maybe it will sort of course correct, which we'll get to in a second. Or is it because there's something wrong with that particular property that's kind of driving that rental yield? So typically you will find, and when you look at sort of median values over very long periods of time in most capital cities, it's hard to find a total return of more than 10%, right? So you can't really be a long-term investor in property and expect a total return of more than 10%.
And just to make things clear, the total return is a combination of your rental yield and your capital growth.
Yep, spot on. So if this property that you're contemplating investing in is delivering a 5 or 6% rental yield, and you think that will persist for the long term, then you're probably looking at a capital growth rate of 3 or 4%. You can't realistically expect also a capital growth rate of 8%. Whereas if you're looking at a property with a rental yield of 2%, then it's no guarantee you're going to get high capital growth. But if you look a little bit further and you look at the attributes of that property, it's probably likely only yielding 2% because it's mostly land value. And then it's up to you to decide whether that land is located in a location that is in very tight supply and high demand.
So I know that your team at Investopoly and ours at Metropole puts strategic plans to clients. So some people need more rent, others need more capital growth to achieve their goals. And that's one of the things that our teams independently map and plan out, because people think, I'm getting more rent now, I can borrow more, I can service more debt. But if it doesn't get you to the end goal in the time frame you want with minimum risk, then extra rent in the short term, especially if it's taxed, isn't going to be the answer to your investment solutions.
Compounding capital growth does all the heavy lifting in building retirement. In terms of building wealth for retirement. And it's just basic numbers really, Michael. If you get a 7.2% compounding return over the long run or more or higher than that, the value of your property, not every 10 years, but again, over many decades on average, will double in value every 10 years. That means if I go and buy $1 million property today, in 10 years it's worth 2, in 20 years it's worth 4. So I've got $3 million of equity in that property. Now, sure, if I go and sell it, I'll pay 23.5% or less in terms of capital gains, but I still keep more than 3/4 of that capital growth return. That's done all the heavy lifting. Rental yield is never going to deliver that amount of wealth in dollar terms over a 20-year period. So it really is all about capital growth, and sometimes rental yield can give us a hint as to what that asset or what a particular asset might provide in terms of future capital growth.
So I took you off track a bit, but I remember in your article you mentioned a couple of things that drive property rental yields, and it was proportion of land, capital growth, expected capital growth are the big ones, and there are two other smaller ones. Maybe, in fact, the market value is less than the technical value at the moment, and potential other alternate uses. But I think we've covered the big two ones, haven't we?
Yeah, that's right. And I think that the one that you mentioned in terms of market value versus technical value is an interesting one because, again, rental yields provide hints for what we need to investigate further. They're not definitive, as I said, definitive indications. But sometimes if you find, well, in fact, quite often markets will move through cycles. And we've spoken about this before in terms of the property market tends to move in quite distinct cycles of a growth cycle and a flat cycle. And so capital growth isn't uniform over many years. They really do go through those two cycles. And I guess only recently we've seen a cycle where median values came off almost 8 to 10%, through last year, but then they've now recovered that lost growth. So there's very short periods of time where you might get greater volatility. But again, if we look at over periods of, 3 or more years, that tends to sort of level out. And so when a market moves through a flat cycle, typically what you'll see is rental yields start to catch up. And then it'll go through a growth cycle, and then the dollar value of rental yields isn't really changing, but because the market value of assets is rising, rental yields as a percentage are dropping. So you won't necessarily get rental growth and capital growth at the same periods of time, but over very long periods of time, they start to become more predictable. So if we're looking at particular markets where we think, this property looks like a really good property, but for some reason I'm achieving a high rental yield, it doesn't always mean that there's too much building value or there's some sort of alternate use or anything like that. Sometimes it can mean that the intrinsic value of that particular asset is undervalued. And so Perth at this stage is a great example of that. Perth hasn't seen a growth cycle for 15 years, but rental yields, it's a very tight rental market, perhaps one of the tightest rental markets. And so it's seen some rental growth. And it's not because, everyone spent all this money improving property in Perth and therefore demanding a higher rental income. It's really just because property is intrinsically undervalued. And so it can be a good hint in terms of what markets are doing at particular times.
Well, the year of 2023 was quite an extraordinary one in history because we had very strong capital growth and very strong rental growth. In fact, the Perth, Brisbane, Melbourne, Sydney rental growth was more than 20% for apartments and houses. It was an unusual situation, but again, that's why I love your approach of evidence-based and looking back at history, because we've got the perspective to say that, hey, this is an unusual year. This is an aberration. Don't make your investment decisions based on it. So I think before we go forward, I want to also explain to the people listening to us today that we're talking about rental yields as a guide. It's not an absolute thing to decide, is it a good investment or isn't it? Properties are unique, their locations are unique. And we've always spoken about independently, but I guess interestingly saying the same thing, that the quality of the investment you buy is critical. And we've got to talk about investment grade properties, because any property can be an investment. You just kick the landlord out, put a tenant in, kick the owner out, put a tenant in, it's an investment. But that doesn't make it investment grade. So how do you use rental yields as a guide? Again, with the proviso that, no, it's not the only criteria.
Look, the way I use it, Michael, is it tends to be a bit of a red flag. So if I'm looking at a particular asset and it is yielding more than what I would expect for that particular asset, and so when I'm looking at houses in a capital city location, I would expect somewhere between 2 and 3% gross rental yield, and apartments maybe between 3 and 5, something in that range. And so if it's outside those ranges, it's typically a red flag for me to look a bit closer at that particular asset and ask some really maybe probing questions around, what is that asset's attributes and how will those attributes impact longer term returns. And I'm not so concerned about what it is today and what it might be in 12 months from now. What I'm more concerned about is what do I expect over the next decade plus? Because when we're making investment decisions, in fact, almost every investment decision should be a long-term based decision rather than short-term based decisions. It invites us to really focus on the fundamentals. But that's even more so with property, because property is very much a long-term asset and it's very costly to buy and sell, to enter the market and exit the market. So we've really got to think longer term. And so if I do have a high rental yield, I really want to understand what's driving that high rental yield. Is it because the property is intrinsically undervalued, but otherwise it's a fantastic property? Or is it a sign that perhaps there's too much building value there, or it's in a location that doesn't have a shortage of supply and excessive demand, which is obviously going to impact the capital growth rate. And so really the aim is to try and understand or look at all the evidence to try and build a realistic expectation of what that future capital growth rate will be. And the yield can be, sometimes the rental yield can be sometimes a bit of a red flag in regards to that, but not a be all and end all. It's really about looking at the individual property and its attributes.
Well, I guess some more inexperienced investors would think, hey, I got a free kick. I got a great property and high rental yield. And your message is, hey, no, be careful. There's no free lunches in property investment, is there? So based on...
And it's possible, Michael, that, some areas, it's not true that if we go to a blue chip suburb, that blue chip suburb will beat every other location over a short period of time. So let's say the next 5 years. It's not true that every blue chip suburb will produce the best return over the next 5 years. There's going to be some outlying suburbs, some new suburbs, new growth areas, whatever it is, that are going to generate higher returns. And that's fine. It's not about trying to pick which market is going to give me the highest return over the next 5 years. If I'm a property investor, I'm going to hold property for 20 or 30 years. It's really about investing in a location that has the highest probability of achieving the highest average return over that complete ownership period. So if you do have a property that's got a high rental yield and you start to suspect, hey, maybe there's too much building value here, it's not necessary that you turn around tomorrow and go and sell that property. It's possible that property still generates some really great returns over the next 2 or 3 years. It might be just a hint that it's not a long-term investment. And in fact, when those returns start to level out, maybe it's about reallocating that equity into some other property that does have the attributes to drive that longer-term return.
Well, clearly you've been around long enough to give us some really valuable perspectives and help our listeners make informed decisions. I know you also help your clients at Pro Solution, private clients, make smart investment decisions. Maybe just let's give you a quick shameless plug. Tell us how you help your clients, because I know your clients do outperform the markets because they're making their decisions based on evidence and facts.
Yeah, so many financial decisions are multifaceted, Michael, and property investment is a great example of that. If we decide to invest in property or we have property investments, there's tax considerations, cash flow, wealth planning, how does it integrate with super? Then you've got borrowing capacity, estate planning. There's a lot of elements that go into it. And so we inspire our clients to take a holistic approach. And so we've built a holistic team at Pro Solution. Michael, we both know that many financial decisions are multifaceted, and property investment is a really good example of that. If I'm investing in property, I'm considering financial planning decisions, how it interacts with super, cash flow. There's obviously tax considerations, and then there's borrowing capacity. And so we've built a holistic team at Pro Solution. And so the responsibility to decide what is important information and then how to react to that information doesn't rest on our clients' shoulders. Instead, we collaborate as a team and make sure that we're covering all opportunities and also all risks for our clients to help them achieve their goals.
I'll leave a link to Pro Solution Private Clients in the show notes, and I'd also recommend people listen to your podcast, and I'll be leaving a link to that as well. Now, I know in your blogs, and I get those every Wednesday, at the bottom you've got a series of videos that people can get as well. So I'd be suggesting if you've got some extra time over the Christmas break to just watch those, just go to Pro Solution Private Clients website. I'll leave a link in the show notes, as I said, and you can entertain yourself watching Stuart on YouTube.
Yeah. Thanks, Michael. It's been great.
Okay, fantastic. Look forward to catching up with you again next month.
Cheers.
I hope you enjoyed my chat with Stuart Weymss, and if you did, and you don't currently subscribe to this podcast or follow this podcast, before we get on to the next couple of segments, just stop for a sec and go to whichever podcast app you're listening to this on and follow this show, so twice a week you get the information that my guests and I have to share with you. And I've also got a link in the show notes for a special bonus for you, just as my way of saying thank you for listening to my podcast. Go to podcastbonus.com.au, and there's a heap of reports and ebooks to help you become a better property investor. Now, with 2024 bringing a different housing market to 2023, are you ready? Are you prepared? If you think about it, last year in 2023, we had significant, strong property growth month after month, double-digit growth in a lot of markets and skyrocketing rents. But 2024 is going to be different. I still think we're going to have strong property markets, but they'll be more fragmented, more segmented, and not any property is going to make a good investment. And similarly, not all homes are going to grow in value the same. So even if you're looking to buy a home, my suggestion is you put your investment cap on, unless it's your forever home. And I know that when we look back in 12 months' time, there's going to be some people who've taken advantage of the opportunities over the year when the markets will again rise, and some people are going to do very well. But there's going to be a whole lot of people who are just going to have sat on the sidelines, just waiting for the message to get clearer. And there's going to be others who unfortunately will have to get out of the market because they've made the wrong decisions. The next few years are going to be very, very different years in property. And if you're a property investor, you may have to change the way you think about property or change your strategy to cope in the new environment. So let me help you. Why not turn to the multi-award-winning team at Metropole for independent, unbiased property and wealth advice? By the way, we're much, much more than just another buyer's agent. We help our clients safely grow into generational wealth through property, but we have wealth advisory and property development, renovations and property management. But even all our property advice is based on strategic, evidence-based property plans that we put together for our clients. We're big enough to tip the scales in your favour, but still small enough to care. So whether you're just getting started or want to grow your existing property portfolio, I hope our team can help you. Let's have a quick chat, and if we can't, we'll definitely tell you, but go to metropole.com.au, and I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today's mindset message is short and sweet. It's something I read the other day and I thought I must share with you. And it was called "No is easier to do, but yes is easier to say." So let me explain to you what that was all about. No is no to one thing, but when you say yes, you end up saying no to 1,000 things. In other words, when you say no to one thing, it's a choice that breeds choices. Tomorrow you can be open to new opportunities, just as you were today. On the other hand, when you say yes to one thing, you've spent that choice. The door's shut on a whole host of alternative possibilities, and tomorrow's that much more limited because you've chosen to do something. When you say no now, you can always come back and you can say yes later. If you say yes now, it's harder to say no later. So there you have it. No is easier to do. Yes is easier to say. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney Podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney Podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?